Good afternoon, everyone. This is Kathy Neufeld, one of the four partners at Agency One. Together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia, I am honored to welcome you to the 2020 Agency One Annual Advisor Conference. This is day 3 of the Agency One Virtual Advisors Conference and our final session for this week. We still have 3 more weeks of phenomenal speakers and content to share with you, and we hope that you have registered and will attend the upcoming sessions. Thank you for joining us. For those of you who tried to join us earlier today for Ed Wren's session on opportunities for wealth planning in the face of proposed democratic tax policies, our apologies for the technical difficulties. We did record this session and it will be available to you shortly. We are also thrilled to announce that we are going to have a follow-up session next week with Ed Wren to provide a recap and also to address any questions you might have. Please be on the lookout for that invitation. I would also like to remind everyone that on Wednesday, October 28th at 12 noon Eastern, we will be hosting our idea sharing contest. 4 finalists will be selected to present their winning ideas for the benefit of the entire group. These 4 will be picked by a group of judges to present on October 28th, and the winner will be picked by their peers during the session. In order to have your idea considered, please submit a 3-minute or less video of you sharing your idea by October 12th. There are only 4 days left to submit your idea. The 4 finalists and presenters for the October 28th session will be announced the prior week. Any idea is a good one. It could be a sales concept, a practice management idea, a networking idea, anything. So please grab your phone or tablet and record something for submission. Should you have any questions, please let us know, but more importantly, please share and have fun with it. Agency One is about to introduce you to a phenomenal opportunity to invest in your own business by becoming a shareholder in an agent-owned reinsurance company. Without further delay, just a couple of housekeeping items. Number 1, all attendees will be on mute. Number 2, you can submit questions through the chat function in the attendee hub. Number 3, the session will be recorded and a link to the session will be made available after this live session. And number 4, please don't forget to complete the session survey after this session. Again, I would like to thank you for being here this afternoon, and I am now going to ask my partner, Gonzalo Garcia, to introduce our next speaker, Bill Shiloh. Gonzalo?
Thank you, Kathy. It's great to see everybody this afternoon on our interactive session with Bill Shiloh. Bill is the President and Chief Executive Officer of Libra Insurance Partners. Libra was formed by the merger of Lifemark Partners and Bramco Financial Resources effective January 1, 2020. He's responsible for the relationships of Libra Insurance Partners and its 61 agencies, as well as developing and executing strategies that fuel the growth and status of Libra in the industry. Libra is the largest independently owned life insurance marketing organization in the country. Bill also serves as the CEO and chairman of Lifemark Re, which is what we're here to discuss today. Lifemark Re is an agency-owned captive reinsurer. Bill's no stranger to the business. He enjoyed a 25-year career at Harleysville Insurance Companies, the last 14 of which he was with the Life Company. And during that time, he headed up sales and marketing as senior vice president. And from 2003 to 2008, he was the president and chief operating officer of Harleysville. As you can see from his banner behind him, he is also a graduate of Penn State. So Bill, without further ado, take it away. We're happy to have you. Thank you.
Thank you, Gonzalo. Thank you, Kathy. It's absolutely awesome to be here today, and good afternoon to all of you. It's my pleasure to be able to talk to you a little bit about the Lifemark Reinsurance Company. We are one of the few reinsurance companies that are a part of a distribution organization. And I really wanted to kind of start off this morning and just talk a little bit about why did we form our own reinsurance company. So I think that, when we were Lifemark before the merger, we enjoyed some significant scale, which was great, and particularly with a lot of carriers, at least our top carriers. And so one of the things we just kept talking about was how could we strengthen our relationship with our top carriers and be able to, provide some financial diversity for our partners within our organization. And so we started talking about the potential and the possibility to participate in the mortality experience of some of the business that we wrote. So, excuse me. We had the opportunity to meet with some friends at the Hanover Life Reinsurance Company to really kind of talk about, what would that look like? What would a opportunity to participate in mortality experience look like from a structure perspective? I didn't really feel that any carriers would really just decide to, cut a check for, participation in this without really the appropriate record keeping and the appropriate kind of risk portfolio. So we talked with Hanover and we talked about the potential to form our own reinsurance company as kind of the structure to house our participation in mortality experience. And then simultaneously with that, we had the opportunity to work with Prudential, who was really looking to strengthen their relationship with our organization and with our partners. So really the two of these things converged, and we had the opportunity to work there with Prudential, have them carve out the Lifemark business, and through our partnership with Hanover, create this reinsurance structure. Hanover got us the opportunity to work with the state of Delaware and put us in touch with a gentleman there that was the director of the captive insurance division. And we sat down and we talked with him. They had never done a life reinsurance captive before. We explained our structure, our process, kind of how we expected to raise our capital and manage the company. And so they allowed us to be chartered in the state of Delaware as an agent-owned captive life reinsurance company. And that gave us a lot of tremendous flexibility, kind of eased up some of the regulatory burden that other type of reinsurance structures would have had for us. And interestingly, also maintained confidentiality of any ownership with respect to the reinsurance company. So those were all important things to us. So when we started off, we got our charter as an agent-owned captive life reinsurance company in the state of Delaware, and we capitalized that. And initially, we were 100% owned by our agency principals. So you had the agency principals of all the Lifemark brokerage general agencies, and they owned 100% of the Lifemark reinsurance company. And then through a lot of work with some of our key partners, and Gonzalo and his team was certainly one of them, we started talking about how could we strengthen our partners' relationship with their top advisors and top producers. And through a lot of work, we created the what we refer to as the agency value or advisor value program, the advisor value program. And that allowed each agency to have the opportunity, again, to strengthen their relationship with the top advisors that they were working with or that they wanted to recruit into their organization. So Gonzalo, do you want to take a couple minutes and talk about how Agency One has utilized the advisor value program?
Sure thing, Bill. Thank you. I think many of you that have known us for years know that Ed Lesher, Dennis, myself, back in the Potomac Group days, we were very much a part of what was called at the time ELAR Partners, which started with Executive Life, but ultimately ran through Hartford Life. And we had many, many years as a partner agency with ELAR Partners. And I think ultimately we distributed close to $120 million of value to the shareholders, many of which were people on this call. So we understand the value of reinsurance. We understand the value of participating in reinsurance. And just one of the things I wanted to bring to the table that Bill touched upon, when we started this arrangement, and Bill, correct me if I'm wrong here, with Prudential, Lifemark agencies were already doing close to $80 million of production with Prudential. So it was a meaningful book of business. Bill's going to talk about some of the other companies that we have in the reinsurance pool now. But we've been big fans of agent-owned reinsurance for many years. We understand the value of it, not only to us as an agency, but to you all as advisors, to participate really in the profits of the business that you're writing. So, as we were talking to Bill and getting this thing up and off the ground, it's how do we do this and how do we make this available to the participating advisors that are writing business with not only Pru, but with some of the other companies. And frankly, what we decided to do was there is a buy-in, if you will, to the advisor value program of $2,500. That's the minimum. And with that, you get a number of shares. Now, in order to buy in, you've got to make a commitment to do $100,000 of production, and not just with Pru, Nationwide, or Symetra, which are currently the participating carriers, but with all of the companies that we do business with through Libra Insurance Partners. So at the end of the day, to the extent that you do $100,000 or commit to do $100,000, you're eligible to buy shares in the reinsurance company, minimum of $2,500. And you've got to validate that year over year. So you can miss at least 1 year. So if you buy in and you miss a year, that's okay. But if you miss 2 years in a row, we just buy back your shares. So that's, no skin off your back. And in effect, it's really just and as you validate production, you're afforded during new offerings to buy, again, anywhere between $2,500 up to $25,000 if you all choose to. And there's a number of people on this call who have bought in. They've bought in because they did 100,000. We're now, putting this out there for if you're committed to doing 100,000, you can buy into the Agency One Advisor Value Program through Libra, which gives you the opportunity to invest in the reinsurance company. Bill, did I miss anything there?
No, you did perfect.
Great. So where do we go from here? We've got new carriers and a lot.
Well, let me talk a little bit about the Hanover partnership, because I think this is important. When we structured our deal with Hanover, one of the things that we recognize is whether it's Prudential or any of the other carriers, they weren't really going to sign a reinsurance contract with a small startup reinsurance company that didn't have a rating. There was no enterprise risk management type of unit in the country that was going to let that happen. So what we did in our partnership with Hanover is these carriers, they carve out the Libra business, and then they cede 50% of the mortality of that business to Hanover. And then what we do is we put in our capital, and then we buy from Hanover on a YRT basis. We buy our share of the reinsurance. So we actually act as a retrocessionaire in the reinsurance company structure. And what that also allows us to do is that we hand Hanover our capital, and they determine how much goes into reserves. They determine how they invest the funds. They pay our claims for us, and they do the financial reporting. So we're able to run this reinsurance company with a very, very low expense structure. Really, quite frankly, with one part-time employee, and that's me. And then we have to have a consulting actuary to do the actuarial opinion, and we also have to have an outside accounting firm, both of which have to be approved by the state of Delaware, by the way, to do our state filings. So, those we work, hand in glove with, but that's really the way the company is structured. So it's a very efficient company from that perspective. And, the more capital we put in, the larger percentage of the business that we own. And I know that, some of you know that we just had a stock offering that ended September 30th. We were able to raise an additional $1.9 million that will go into the company and increase our share of the business. All the reinsurance business we have right now is on a YRT basis. So, even whether it's term or whether it's permanent, we're taking the mortality exposure on a YRT basis. I think an important part of what we did when we structured the company was we created an aggregate stop loss. And so we pay Hanover a small percentage of our capital, and we created an aggregate stop loss so that Lifemark Re can never lose more than 20% of its capital in any given year. And I think that's really important. You know, the way this business works, I mean, you know, we reinsure some large cases. So if we have, let's say we have 20% ownership and, you know, a $10 million case. So a $20 million case is written with Pru, 10 million goes to Hanover, and a death occurs on that, and we have 20% of that, that's $2 million. So that's a relatively large hit to our capital. So if our capital at the time was $5 million, well, that would be more than 20%. So we would have a stop loss then that would stop our losses at $1 million under that scenario. So that just gives you an idea of the way it works. So it really protects us from those very, very large losses that could occur, you know, either from a frequency or severity perspective, you know, in the life reinsurance business. And so, you know, the nice thing, and I get this question a lot, is, hey, if we invest money, are we ever going to be required to put more money in? You know, and the short answer to that is that shouldn't really ever happen. In order for that to happen, you know, you've got to trigger this aggregate stop loss 5 consecutive years in a row in order to have this company suffer financial damages. So, you know, that's you know, a good strong point of the Lifemark Reinsurance Company, and the cost for that stop loss is relatively nominal. As Gonzalo mentioned, we have 3 participating carriers in the program right now. Prudential is in there. We get 50% of the exposure on term insurance, and then we get 5% of all the permanent insurance mortality put into our program. Nationwide, we are in there. They're in our program rather, and we get 50% of the mortality on all permanent business with Nationwide, and the same with Symetra. Symetra is in for permanent business, and we get 50% of the mortality on any of the business written with Libra into those carriers. So, Gonzalo, you want to go to the next slide? So this is just to give you a feel for what's in the reinsurance structure right now. So we actually started discussing the program in July of 2016 with Prudential. And they were so excited about it that, you know, we started off with a nominal amount of business being ceded to Hanover in July of 16, but then beginning in July of 17 and throughout 18, July of 17 rather, January 17, that business started coming to Hanover, and even though our reinsurance company wasn't started yet, they just warehoused that business for us. So Hanover was warehousing it, and when we were able to charter the company, get the reinsurance company formed, you know, on 1/1/2018, we already had $11 billion of face amount in the structure. So on day one, when we started the company, we had $11 billion of face amount, and we were collecting premium on that amount of money, on that amount of face amount. And then if you look at the amount of face amount that we have in June of 2020, we are up to $23.3 billion of face amount with the 3 companies that we currently have in the program. So our structure is growing. It's growing very nicely. You can see that we started off, when we first put capital in the company, we started off owning 21.9% of the business. And then when you get to the end of June of 2020, you can see we're down to 13.6% of the business. And that's because the pace of growth of our business outpaced the capital that we were putting in the business. So, you know, that's something that, you know, we've got to constantly contend with, is our business continues to grow and we need to continue to put capital in. Now, one of the things that everyone needs to know when we structured the company, and in fact, we put this in the shareholder agreement, that for the first 5 years, we are committed to reinvesting our profit back into the company so that we can continue to beef up our ownership in there. So we would never pay any cash dividends, at least for the first 5 years. We have issued stock dividends. That does keep the capital in the company and yet recognizes the folks that have made an investment in the organization. So we have issued some of that. You can see the number of lives. We started out in 2018, so that was really 2.5 years of business, really, when you think about 16 to 18. We had 41,000 lives in there. And then at the end of, actually, that's supposed to be 3/31/2020. Sorry about that. 3/31/2020, we had 74,286 insureds in our program. So it's growing very, very nicely, and you can see how we expect this thing to kind of continue to grow, particularly with the carriers that are in the program right now. Now, obviously, we pay claims, and so you can see in 2018, we had 39 claims. I will tell you that in 2019, we had 70 some claims, and now through 6/30 of 2020, we now have paid so far 20 claims through the second quarter. So we know there are going to be claims, and we're prepared for that from a financial perspective.
Hey, Bill, just a quick question. A lot of people had asked me how's COVID impacted Lifemark Re. I mean, with the increase in mortality that everybody thinks is out there, is it a big risk for Lifemark Re to be in the reinsurance business during this COVID period? You want to address that for a minute?
Yeah, sure. Well, we've obviously been tracking it. We've been talking about it since the beginning of the pandemic. We have had 5 insureds that have died from COVID out of our 74,000, and a total of 6 policies. One of the insureds had 2 policies. Mm-hmm. So the overall impact certainly has not been huge. I mean, and you wouldn't expect it to be, since our business really has been underwritten, over the last 3 to 4 years, right? So, I mean, our longest duration is 4 years. So, had anybody had, serious comorbidity issues, you would have hoped they would have been kind of underwritten out. But we did have some, a very small percentage. And I think, too, that, one of the things in talking to the folks at Hanover, even on their entire block of business, while everybody's looking at the COVID death claims, the reality is that, it's not as much an increase in death claims as it is an acceleration of death claims. In other words, you have someone who's 81 years old that passes away from COVID, their life expectancy may have been 83. Yes, it's a COVID death, but it's really kind of at the tail end of the mortality expectation. So, that's kind of the reality when it comes to COVID claims, but very, very small impact on us. Face amount wise, death claim amount wise, it was just right over $100,000 for us. So Mark Re, $100,000 of claims. So let me just give you some insight into our second quarter results. This is the latest reporting that I have. We had a little aberration in our reporting, in that Prudential had a change in their product. They went to the 2017 CSO tables in July, and as we looked at the treaty, it required a new treaty that would have been effective 10/1. And we did not get any reporting on that business because of A, the new treaty, and B, their conversion to a new reinsurance system. So 10/1 to the first quarter of the year, there was no real reporting from Prudential. In the second quarter, all that reporting caught up. So what you see here is that if you look at the premium at the very top line, excuse me, you see that we came in at $658,340. That amount of premium was 29% over the second quarter of last year. So real good growth in our premium. And then you add in the 169,000 that was unreported, that became reported in the second quarter, took our total premium for the second quarter up to $827,000. That showed an increase of 62%. One of the things that we get from Prudential is we get a small sales load on top of the reinsurance premium. And that was really an incentive for us to kind of continue growing our business at Prudential. And you can see that our sales load through the second quarter was 87,510 in the second quarter of 2020. That was up 28% over the prior year. Again, very relational to the amount of premium that we were up. Again, if you look at the unreported number was 33,000. So our total sales load number came in at 120,896, up 77%. Our claims paid for the quarter was at 225,000. This was 43% less than the claims we had paid in the second quarter of last year. And then if you look at the reserve change, we had a reserve takedown of 29,000. So the total claims hit for the quarter was 196,588. So the net settlement amount, so this is kind of like the profit before expenses and taxes and all that type of stuff. And this is on a statutory basis. So we came in at 718,000 versus 2019, where we had a loss of 120,000. So huge difference in the two quarters. And you can see we add, if I take out the impact of that Prudential business and the profit associated with that, our normalized profit would have still been 515,429. And in our short duration as a reinsurance company, the best quarterly profit we had had up to this point in time was 388,937. So we had a really, really good second quarter. But again, it's just, it's one of those things that, it is, by reinsurance perspectives, a new and relatively small block of business. And I think everyone needs to understand that there will be some volatility in our results.
On a quarter-to-quarter basis. I mean,
quarter-to-quarter basis.
No doubt.
Yep. So if you go to the next slide, go ahead, Gonzalo, do you have something?
Yep. No, I just switched slides for you.
Okay.
Good.
So I wanted to just talk a little bit about the ownership. This is a big deal as we try to own more of the business that we could participate on the mortality experience. I mean, that was the objective of the entire strategy. So you could see that at the end of June, we had a 13.6% ownership. In May and June, we had our first stock offering. It was called a catch-up offering, and it was primarily targeted at, you heard Gonzalo say we had a merger between Bramco and Lifemark. So we wanted to give the Bramco agency owners an opportunity to buy into the Lifemark Reinsurance Company, and any prior Lifemark agencies that maybe hadn't reached a maximum or wanted to put more in. So we had what we called a catch-up stock offering. And we raised $2 million on that. So that added 4.5% to our total ownership. So at the end of the second quarter, the beginning of the third quarter, we'll have 18.1% ownership. Now, the other thing that we're doing is that there were some reserve changes that occurred. I won't get into a lot of detail, but the reserve changes that Hanover was required to make, with all the stuff going on with reserves, we knew there was going to be an increase in reserves. So one of the things that we know, we need to hold our GAAP reserves, but we're going to start financing the difference between our GAAP and our stat reserves. So we'll get a credit for our a reserve credit for our stat reserves through this financing structure. Well, since we won't hold the actual reserve, we'll pay a finance charge on those reserves. And when we do that, that will put some additional capital back into the company because they won't be tied up in the reserves. So that will add 2.5% ownership back into the organization. And then, as you just heard me mention, so that takes us up to 20.6%. And as you just heard me mention, we just raised another 1.9 million. So I expect that, and when I did this pro forma here, I was expecting $1 million, but that'll take us up maybe another 3 to 3.5%. So we'll likely end up around 23.5%. But if we did end up at 22%, just to give you an idea of what this means, that 718,000 of profit that we made in the second quarter, if we would have owned 22% of the business, that number would have been 1.193 million. So that's why it's real important for us to kind of continue to grow our ownership of the company. And, I think that, as we do that and we get up to that, 30, and like I said, we can get up to a maximum of 50% ownership. Hanover will always own 50% of the business because they're determining the rates and they're determining all the financial mechanisms of the actual reinsurance structure. So I think that's really important. And, as I said, we in return, they get 50% of the business, but there's really no cost to Lifemark Re for them doing any of that work. It's just a true partnership. And that's the way we're structured. So, hey, you see this word risk over here, and I want to talk just about that for a couple of minutes. Like I said, we're a relatively small company. There's certainly some risk associated with it. We have a stop loss built in there, but there is going to be volatility. And, when we look at this thing, our partners, our board, everybody is looking at this over the long term, understanding that there's going to be ups and downs as far as, mortality is concerned on a quarterly basis and maybe even on an annual basis. We've got the right protections in there with the stop loss. So we don't believe there's adverse financial risk, but we are going to have some volatility. And I just want everybody to know that. And for that reason, one of the things that we did when we filed this company with the SEC is that we use the accredited investor kind of structure. So you do have to be an accredited investor to invest in Lifemark Re. Now, if you're on this call, you most likely will meet the accredited investor requirements, and I won't spend a lot of time on them. But, by its very nature, the accredited investor rules basically, insinuate that there may be a little more risk associated with this investment than there would be with a standard mutual fund. And so just so you understand that.
Hey, Bill, can we run through, so when the company was started, the shares were sold at par value of $1.
Right.
Fast forward 1 year later, fast forward 2 years later, can you talk about the growth of the value of the shares, which I think would be of interest to the folks on the call?
Sure thing. Yeah. So at the end of the first year, the valuation came in, and I want to say it came in at around $1.16 a share. And then we issued a stock dividend, which then diluted the value of those shares to $1.11. So in year one, if you bought in year one, you bought at $1. If you bought again in year two, you bought at $1.11. And then this past year, the valuation came in at $1.21. We issued again a dividend, which diluted the value down to $1.19. And so you bought, if you bought this past September, you bought at $1.19 a share. Okay.
So just to reiterate that, in year one it was $1.17. You got a 6% dividend share. So $1.11, $1.21, and now you're at $1.19 because you
Right.
got a 2% dividend share. So those
Right.
dividends, so you had 8% in dividends reinvested, and then you had an appreciation of the value of 19 cents over a 2-year period. So it's really $1.27.
Yeah.
So it's pretty good results for a 2-year period.
So far, so good.
Yep.
So far, so good. And I think what you're starting to see here now, with the ownership going up, the change in the reserve structure, I think that this, we're positioned well for future growth and value.
Mm-hmm. So speaking of the future,
A little bit about future strategies. I mean, one of the really nice things about having our own reinsurance company as a distribution organization is it gives us some strategic flexibility. And, the first thing is that, we have 3 companies in the structure. We'd like to have 5. I think that, diversification of business is important when you're in the reinsurance business. So we do want some additional diversification. We could probably, but at the same time, we want companies to feel differentiated as they go into this structure. So it's kind of a balance for us. And we've decided that, like I said, 5 to 6 companies is about the right number to have the right diversification in our reinsurance structure. So, we are talking to a couple of companies. We have no deals yet, but we're talking to John Hancock, we're talking to Principal, and we're talking to Mutual of Omaha. So, we have other companies, and, these conversations take a long time. There's a tremendous amount of modeling goes on, through this process, different types of structures. And quite frankly, one of the things that we've seen is because of PBR, companies are now looking at different structures. Instead of YRT reinsurance, they're looking at co-insurance structures. And so now we're modeling, even with Hanover. Hanover may take a co-insurance structure with a company, but we still want Lifemark Re focused on YRT mortality. So how do we bifurcate that type of structure? So we're doing some serious work with this. I think it's going to be fine. And but again, it gives us tremendous flexibility. Another thing that we get the opportunity to talk about with carriers is proprietary products. Since we're able to take risk on some of these products, and Hanover is able to put these co-insurance structures in to take capital strain, we actually are in a very, very unique position to be able to talk about proprietary products with some of our carriers. And we are right now. Nothing really for me to report on per se. It's all in kind of the infancy stage of what if, and what would it be aimed at, and how would it work, and what do you really need? Those types of conversations are going on right now. And but I do believe that sometime in the next 12 to 24 months, we should have a proprietary product where Lifemark Re will be kind of at the core of that strategy with that particular carrier. And then last thing is we also have the opportunity, and again, this is a bit of diversification as well, to do a proprietary annuity product. A diversification against mortality is annuity. So, wouldn't be a bad idea for us to put one of those in the portfolio. I think we are going to explore some of that. We had that discussion at our last board meeting, and we'll talk about it. I think it's going to, again, I'm talking about a 12 to 24 month time horizon here, and a totally different type of partner when it comes to proprietary annuity products. So again, a lot of opportunity, a great long-term future in my mind for the Lifemark Reinsurance companies and for our agency partners and the advisors in the advisor value program that really want to participate and be a part of something that is really different out there than any other distribution organization really has. And I know that M has historically had a reinsurance company for a long time. Theirs is structured a little bit differently than ours, and that's okay. But I think that when you look at the other marketing organizations out there in the distribution arena, there's nobody really that has one like ours. So with that, I'm happy to take any questions that anyone has.
I have a number of questions, Bill, and I would encourage anybody to use the chat function inside of Zoom to ask me any questions, and I'll be happy to read them to Bill. But you talked about opportunities to purchase shares. Can you talk about, is it going to be once a year? Is it going to be twice a year? How do the offerings work?
Yeah, so for specifically for our partners, it's once a year once the GAAP earnings are done.
Mm-hmm.
For the advisor value program, my intention is, we do that again once we have the GAAP earnings, and we do that first stock offering, which ideally should be in July 1st. That would be one opportunity, and then when as Gonzalo and his colleagues are out recruiting additional advisors, we want them to have the opportunity to get into the program, at least with their initial capital contribution. And so we're hoping to have a second offering around November, December for the advisor value program participants, not for our partners.
Got it. And Bill, what happens to the shares if somebody retires?
So if someone retires, obviously we are structured as an agent-owned captive, and many folks keep their license, and that's fine. I think that as folks retire, we want them to be able to participate in any dividends that we're doing. I mean, these are the people that help build up the equity of the company and help build the company through their production. So if they truly retire and don't do business somewhere, part of the deal is that they need to do business either, if you're an advisor value in the advisor value program, you're doing business through our partners. If you're a partner, you're doing business through Libra. As long as you truly retire, you are able to keep your shares and enjoy the dividend and the appreciation of the company.
That's great, which is what was going to, the other question was, what happens to my shares if I stop doing business with Agency One, or Agency One stop doing business with Libra, or you don't meet the minimum threshold. So I think I discussed that earlier. If you own shares currently, and the requirement is to do $100,000 a year in order to retain shares and retain the ability to buy more. If you miss that 100,000 2 years in a row, then you get bought back. So that's just the way we're running the program now, because at some point we want to make sure that we're all in this together kind of thing. So we want to make sure we've got productive and active partners in the reinsurance company.
Yeah, and when we buy that back, we buy it back at current book value.
Yep.
Whatever that is.
The other question I get a lot is, can I have an entity own the share? So can it be owned by a trust? Can it be owned by a family partnership? Can it be owned, kind of talk about ownership there for a second.
Yeah, I mean, as long as the core owner in whatever structure, whether it's a trust or whether it's a family partnership, whether it's a LLC, any of those are fine. As long as the core owner is a licensed agent, then we're fine. And that has always been, we work very hard with the state of Delaware to get that concession. Because a lot of our partners hold it in the name of their agency. Some, like you said, Gonzalo, have formed family partnerships or specific LLCs that actually hold these shares, which is fine.
Right.
Just remember that the entity has to meet the requirements of the accredited investor.
Right, absolutely. There's a few other questions. I think so many of them have been answered. Does anybody have a question that you would want to put into the chat box? I'd be happy to read it. One of the other questions I had was, is it ever anticipated that these shares will trade in the open market? So currently it's a private placement. Obviously there's no liquidity in the market. So what are your expectations of that?
Yeah, I would not see that, Lifemark Re would go public. That's not an exit strategy that I think, would be appropriate. It'd be very difficult, again, just because of the way we're structured as an agent-owned captive.
Yep.
I think that's a challenge in and of itself. We could potentially use as an exit strategy, obviously Hanover would buy the business back. That's a very logical one. The participating carriers could do that. There could be an entity that would come and be willing to take that business, and even if they weren't an agent-owned captive, but they were willing to form their own reinsurance company under regular reinsurance structures, there could be the potential that another reinsurance company or a startup reinsurance company would want to buy Lifemark Re. And again, the challenge there is, if SCORE came to us tomorrow and said, hey, we want to buy Lifemark Re, then the question is, what does that Hanover partnership look like? And how do you separate that business if, in fact, Hanover doesn't want to be a partner with another reinsurance company? But, as I said, our intention is to be in this for the long term. And, we think that we can grow this and we can grow value, both from an appreciation and a dividend income perspective.
Got it. Well, I'll ask the last question and we'll turn it back over to Kathy, Bill, and thank you. You talked about a 5-year holding period. So we're getting back to the issue of if it's not going to be, if there's not an immediate or intention really to go public or sell, then clearly people are buying this not only for the growth, but for the dividend stream. And so you talked about a 5-year holding period where dividends would be reinvested in the capital of the company. Is there an anticipation of dividend payouts would become available after that year 5? And is it year 5 as of inception in 2018? So we'd be talking about 2023, or kind of how do you see the dividend streams coming out at some point in the future?
Yeah. So first thing is it is since inception, so which would be 2023. Okay.
Got it.
That's the way the shareholder agreement at least is written. And again, I think from a board of directors perspective, again, our objective is to get to what we refer to as significant ownership. So, is that 35%? Is that 40%? Knowing also that it's a moving target. I think one of the things that we've become real clear on is that to say we wouldn't ever pay a dividend until we got to 50% is just really unrealistic, because that's just a moving target all the time. So there's just got to be a level of ownership and income that we're comfortable with, that we would say this is kind of our target arena, and that we would pay dividends when we're in this arena. So that I'll just use 35% as an example. So if we get to 35%, and let's say income is $3 million, maybe we say we pay a dividend of $2 million, we keep $1 million in there. Again, just to kind of keep the ownership structure, where what we don't want to do is pay out dividends, let the ownership shrink back down to 25%, and then have to rebuild it again.
Right.
So stability will be kind of the key objective as we get into that arena.
Great. Well, Bill, thank you. And Kathy, I'll hand it back over to you.
And thank you. Thank you, Gonzalo. Thank you, Kathy.
And just one last thing, Kathy, before you go, if anybody has any questions about Lifemark Re shares, please reach out to Kathy or myself, and we'll be happy to get you all the information that you need if that's of interest to you. So Kathy, over to you. Thank you.
Yeah, that's exactly what I was going to conclude this with. Bill and Gonzalo, thank you. If you have any questions, as Gonzalo said, myself, Gonzalo, will reach out to Bill. With each offering comes a private placement memorandum. It's fairly thick, as most of you are aware, if you've ever participated in a private placement before, but they come with a cheat sheet with some helpful hints as to how to fill out the documents, and it is relatively easy. And I'm happy to spend time with you on the telephone, filling out the documents, and sign here, here's what this means and that means. So we try and make it easy, and we are available. So with that, a couple housekeeping items. Please remember to fill out your surveys. They will be emailed to you sometime this afternoon. We do have some terrific sessions coming up this coming Tuesday. The first one is at 12 o'clock Eastern Time on how to clarify your message so customers will listen, and how the power of story can help you grow your business with Tim Arnold from Story Brand. And then later in the day, we're going to have a workshop at 3 o'clock that's going to be hosted by Gonzalo on how charitable planning with life insurance has changed. We hope that you will join us next week. Thank you for your participation, and please reach out to Agency One if we can be of any assistance. I hope everyone has a terrific weekend, and we hope to see you again next week. Take care.
Thank you all.